Welcome to Bloomberg ETF IQ Europe. I'm Francine Lacqua. Over the next 30 minutes, will be your guide to the region's thriving market in exchange-traded funds. Everything you need to know about the funds and the flows. As Germany extends virus restrictions and the UK enters another lockdown, well, will Europe's economic deep freeze finally lift? We'll discuss what it means for investors. The trillion-euro market as Europe's ETFs cross a milestone. We'll also ask what innovations will keep it growing in 2021. And a strong start to the year for gold, but could an unwinding of large ETF holdings prove a major headwind for bullion? With the White House and Congress soon to be both under Democratic control, blue wave trades took off this week. Now, in Europe, sector ETFs linked to Biden policies saw inflows, while reflation plays also advanced. Well, joining us to discuss all of this is Bloomberg's Danny Berger. Hi, Danny.
Hi, Francine. Well, I have reflation trades up here, but I also want to talk about thematic funds as well. So I want to show you the full screen for that as well, because after the Georgia election, we saw a lot of thematic-based funds do extremely well. So that's things like clean energy, for example. We have Biden, for example, proposing a $2 trillion fund to help with clean energy initiatives, get the industry off of coal by 2035. So we saw that fund advance to its highest level since its foundation, since that ETF came to market. It's an iShares fund. We also saw other sort of thematic plays do very well. For example, cannabis ETFs. This one is from Han ETFs, gained 6.2%. Again, all of these are on January 6th. So this is the really initial reaction to the Georgia election and the U.S. Senate turning blue. Finally, we have the USA SRI fund. So this is a social responsibility investment fund. So again, it's playing into that sort of ESG thing. Francine, you and I both know thematics are really popular among European investors. So they really took this chance, this election results, to look at these thematic ETFs and go ahead and buy some more that really play well into that Biden blue wave sort of trade.
Danny, what about reflationary plays? So are European ETF investors betting on those as well?
They certainly are. And this is a trade we saw start to be put on when Biden was first elected after those initial election results as well. So that was the other one we were looking at. That was when bank ETFs really took off. They were actually the best performing ETF in Europe on January 6th. So with an 8.2% gain, we saw things like energy do very well. So again, that's that reflation, that opening up sort of trade we had seen before. But now it's due to more stimulus expected out of the U.S., more growth. So we see energy do well, and even U.S. small cap value does well. Now, this is a fund that had really only come to market over the past few months, but that gained more than 5% in the day of the election. So it really shows that it's not just investors in Europe, it's also Europe-listed ETFs that really has some excitement around them regarding this inflation trade.
Why, Danny, would investors actually use ETFs to trade the blue wave instead of single stocks?
Well, we see this a lot in the ETF world when there's a big overriding macro story that's perhaps different than what investors had thought, that they need to change suddenly. It's much more easy to go in and buy an ETF owning a basket of, be it themes or these sort of reflationary stocks, than go out and pick individual winners. It's a quicker way of putting on this trade. A lot of times we do see these sorts of ETFs act as placeholders. And for example, maybe later investors will go in and pick out the specific energy names that they want. But in the initial aftermath of a big event, it is very common that we see this played out in ETFs versus single stock names, Francine.
Danny, thanks so much. Our Danny Berger there with some of the moves that we've had this week. Now, the Bank of England Governor Andrew Bailey has risked reigniting the politically charged debate over Brexit by predicting that the trade deal struck with the European Union could end up costing the UK economy the equivalent of more than £80 billion. Well, his warning comes just weeks after the long-sought trade agreement between the EU and the UK was sealed. But what's the investment angle with all of this? Will the economic actually pain mean losses for UK stocks, or are there opportunities from the deal? Well, joining us now to discuss all of this is Bloomberg News' Ksenia Galuchko. Ksenia, thank you for joining us from the ETF perspective. So has there been a shift in investor sentiment towards UK stocks since the Brexit deal?
Absolutely, Francine. UK stocks are now heading for their best start to the year on record as investors are betting that the UK economy can finally start recovering from the pandemic and Brexit volatility. You've got the likes of Citigroup and UBS Wealth Management saying that UK equities are cheap and attractive thanks to their high yields. And investors are obviously really relieved that the Brexit trade deal talks are finally behind them and there's more clarity ahead. Now, UK ETFs have been seeing powerful inflows since the end of last year. And in addition to the removal of the no-deal Brexit risk, we also have positive sentiment coming from the U.S., where Joe Biden's victory and the Democrats' win in Georgia are fueling bets on more fiscal stimulus and infrastructure spending. Reflation trades are booming all over the world, as Danny has told us, and UK equities are one of them thanks to the high presence of energy, banks, and mining stocks among them. So finally, after years of underperformance, of being the world's biggest underweight position, and after the FTSE 100 last year saw its worst year since the global financial crisis, it looks like UK stocks are showing signs of recovery.
So, Ksenia, which ETFs are the key ones to watch in terms of UK flows?
Sure. So in the last week of last year, the largest UK equities-focused ETF, iShares FTSE 100 ETF, saw its biggest inflows since last March. It was about £180 million coming in. The other ETF to watch is the Vanguard ETF, focused on the mid-cap FTSE 250 index. That has been also seeing a surge in inflows, and investors pulled in about £500 million in December alone. That was the biggest monthly inflow in a whole year. Citigroup is saying that these big inflows into more domestically oriented UK ETFs has actually been a really strong sign that investors are betting on the nation's economic strength and recovery. And in the new year, UK ETFs are continuing to see demand from investors and inflows go on.
Ksenia, thank you so much. Ksenia Kaluchko there with the very latest on the UK. Now, coming up, holdings in bullion-backed ETFs are near 3,500 tons. That's equal to about a year's mine supply. But could an unwinding by ETFs drive the gold price lower in 2021? Well, we'll have more on that next. This is Bloomberg.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, a strong start to the year for gold. The weaker dollar and rising expectations for U.S. inflation have added to demand for the yellow metal, boosting its appeal over havens like treasuries. But could the unwinding of large gold holdings by ETFs prove a headwind in 2021? Well, let's get more with our Markets Live editor. He's Eddie van der Waalt. Eddie, thank you for joining us. How big of a swing factor are actually ETFs in the gold market?
Francine, yes, the ETFs have become increasingly important for the gold market. As you said before the break, they hold about 3,300 tons at the moment, which is equal to about a year's worth of mine supply, or $210 billion worth of gold sitting in there. So if these things unwind, they're a significant swing factor. We've seen that in the past. Every year that ETF holdings fell, gold prices fell as well. And I think it's actually a bigger swing factor than the futures market at the moment.
So does that mean that it could trigger a sell-off like we saw in oil last April, or is it just a widely different market?
Yeah, the oil sell-off was spectacular, and the gold ETFs are important, but they are very, very different beasts. The oil futures, the oil ETF contracts are mostly backed by futures, whereas the gold ETFs are backed by physical bullion, which means that there's just more of a connect between the actual physical market, and gold's just also much easier to store. I think if gold looks anything like it's going to trade negative, people will be queuing up outside the COMEX warehouses to take delivery. It's not as hard to store as oil is, and therefore the opportunity for gold to actually go negative is almost zero.
Eddie, I can't let you go without torturing on, a couple of questions on Bitcoin. I mean, it was down, now it's up. What's the latest?
Yeah, but Bitcoin's wild, and it's probably going to be wild one way or another this year. I think a big swing factor there could be if we actually see an ETF launch there. I also spoke to a market source this week who said that he's thinking about launching a ETF for blockchain companies that work on Bitcoin. So I think there's a lot of interesting movement in this space. It's definitely something that could develop this year.
Great, thank you so much. Our Markets Live editor, Eddie van der Walt. Now with us, Andrew Jamieson from Citigroup. Andrew, I don't know whether to ask about Bitcoin or gold, but actually, what's the role of gold ETFs right now?
Yeah, so I think gold is an important asset class in its own right. It has historically always been seen as a safe haven. And ever since the advent of gold ETFs, they've been an easy vehicle for people to use to accumulate gold. As Eddie mentioned, they're physically backed. It's much easier to trade a stock as an ETF rather than to hold physical gold. So they play an important part for people that feel that they need that safe haven. And as you mentioned, there's been a lot of inflows into gold recently. I think a reflection of the COVID pandemic and the fact that the economy has largely been in hibernation over the last 9 months. And therefore, it's not surprising that there's a lot of activity going on in gold ETFs.
But is there too much activity, or is there, such a thing as too much activity if actually gold ETFs, completely change the price if somebody gets out of it?
No, I don't think they represent a meaningful proportion of the overall gold market, and there's a very very well functioning primary creation redemption process that surrounds it. So ETFs are fit for purpose. There's not been any issues with regards to that, and I don't foresee any in the future.
All right, thank you so much. Andrew Jamieson there from Citigroup, who stays with us. Now, coming up, investors bet big on smart beta. Factor ETFs in Europe see the biggest inflows on record. We discuss that next. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now let's take a look at the smart beta winners and losers over the past month. Here's our Danny Berger. Hi, Danny.
Hi, Francine. It was a really big month for smart beta ETFs. In fact, at nearly 11 billion euros in the month of December, they saw record inflows. It was really driven all by ESG. But let's take a look at what they look like over the past week. And I think this is to end the year in a little bit of 2021. Size and value both doing very well. The first and third biggest inflows over the past week. Those are definitely that reopening trade despite more and extended lockdowns in Europe. Size, of course, looking at small cap values. So you're looking more economically sensitive funds. But a little bit different from that is low volatility. Low volatility had a really bad 2020. The strategy actually swung more than the overall market, and it's not supposed to do that in a volatile environment. So a lot of investors cast aside low vol, but in the final week of the year, it got more attention, seeing $75 million worth of inflows in the European listed market. Now, in terms of outflows, it was really quiet over the past week. It was all about buying funds, positioning for year-end for 2021. We didn't see a lot of selling. The only strategy we saw sold there was quality, losing $17 million worth of flows over the week to Jan 4th. But ESG and growth both flat on the week. ESG has had a banner 2020. It's hard to overestimate how well ESG did in terms of garnering interest for the entirety of the year. So maybe that's why it was flat. Perhaps people have already allocated so much there wasn't really anything additional they needed to add. So that's a record year for ESG in 2020, despite the fact that it didn't see any net inflows for the past week, Francine.
With the very latest. Now let's get back to another of our top stories as we start 2021, and it's, of course, virus vaccines and the outlook for the global economy. David Solomon, Goldman Sachs chair and chief executive, spoke to Bloomberg about the importance of getting people vaccinated in the hopes of emerging from the pandemic on the other side. He spoke to our Sonali Bazek.
The toughest task that the new administration has is continuing to march forward to make progress on getting the vaccines distributed so we can get to the other side of the virus. There is going to be a lot of discussion about what additional stimulus is needed. We've raised a bunch of issues here this morning where we're trying to get people focused on things that we think needs to be included in any additional stimulus that's brought forward. But I think the big focus right now is we've got to get people vaccinated. We've got to get to the other side of the virus.
Well, still with us, Andrew Jameson from Citigroup. Andrew, when you look at, vaccinations, the pace of the recovery, how are you expecting ETFs to actually, to deal with that into the next 6-7 months?
Well, I think we're already seeing it. And as Danny and you were just mentioning about smart beta, this second generation of passive investing, trying to filter in or out certain attributes and being very factor focused. We've seen that in terms of when the initial euphoria of these vaccines coming out, we saw that great rotation out of growth stocks that had been doing so well in the sort of the e-commerce economy versus more traditional value stocks that you mentioned are more economically sensitive. So we're certainly seeing the use of smart beta. We're certainly seeing these ETFs being deployed for people to take advantage of this evolving situation. And smart beta is often viewed as that halfway house between passive and more traditional active investing, and is possibly more cost effective and less risky. So I think, you'll certainly continue to see that as we progress into 2021. But I think the other thing that we're seeing really significant interest in is that concept of thematic investing, filling the void by possible dissatisfaction with more traditional active funds, and really epitomizing the entrepreneurial spirit that's embedded in the investment industry. And, this is something that, my colleague Scott Cronart's talked about for quite a while now, and something he sees as a natural evolution in trying to get more effective alpha alternatives. So I think we really expect a range of products to broaden in that thematic universe, and certainly an overlay with this ESG trend that we're continuing to see. So any exposure that has prospered, if you can use that term, such as e-commerce, cloud computing, robotics, or as we've seen in the US, in particular, healthcare innovation, such as the ART Fund, I think that's going to be a big trend in 2021.
When you look, Andrew, at some of the themes that were big in 2020, so this is ESG, maybe digitization, even maybe some medical-related ETFs, is that what will grow the most this year?
Yeah, I think they'll certainly take a lot of inflows. You've got to look at it in a comparative basis. So the big mega funds will continue to take a lot of inflows, and therefore proportionally they may be the dominant part of the flow. But I think the growth of the market in terms of new launches and what's coming in 2021, I think thematic and ESG will definitely be to the fore. And I think really the adoption of ESG has taken the investor landscape by storm in the last year. Assets in the ETF universe, both in Europe and in the US, have doubled. And although this was traditionally seen as a European phenomena, the fact that the US has caught up so rapidly has really taken a lot in the industry by surprise, and is opening up a new frontier in the sort of traditional ETF battleground. I think that's really the front that all the issuers will be fighting in 2021, and you could see that as the evolution of the fee wars, or the arguments that raged over synthetic versus physical in the past. So, it's certainly going to be a very exciting and interesting time to see how different firms tackle this challenge in different ways.
But Andrew, how much more transparency will we actually see in ESG investing?
Yeah, that's a great question. So, I think today it's still very much a relatively nascent process. We're still looking at first generational products. They're looking very much on an exclusionary basis. I think we need to move then on to governance and real impact investing. I think these are all innovations that are coming, but it's really how the industry can move at a pace to try and embrace these changes and really ensure that they stay attuned with investor sentiment and demand.
Andrew, thank you so much for joining us. Andrew Jamieson, there, Global Head of ETF Product at Citigroup. Well, that's it for this week's Bloomberg ETF IQ Europe. We'll be back, of course, with more next Wednesday. That's at 9:30 a.m. London time. We'll have, of course, our full cast of experts. We'll be speaking to experts from the ETF world, not only in Europe. We'll have our Danny Berger looking at the funds and the flows. Plenty more on ETFs right here on Bloomberg.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.